Hi, everybody. This is Alan Ellman, the Blue Collar Investor, with our BCI podcast number 47, titled Rolling Up in the Same Contract Month. We're going to use a real-life example with CarMax Inc., which trades on the New York Stock Exchange under the ticker symbol KMX. Now, position management or exit strategies is a critical part of our option selling strategies. It really is what distinguishes us from other covered call writers and put sellers throughout the world. Now, one of the questions that we must decide is how and when to act on our current option positions. And sometimes no action at all is the best route to take. Other times there are certain specific exit strategies that will create opportunities to mitigate losses, enhance gains, and frequently turn losses into gains. So as far as exit strategy opportunities for covered call writing, we know that position management is the third required skill. So once we have determined how to select the underlying securities and which options to select, we immediately go into position management mode, the third required skill. Now, these opportunities do come up frequently, but they're not always there. So we must decide whether or not such an opportunity exists. We don't want to take action just for the sake of taking action. And if we decide that there is an opportunity to enhance our position, what is the best exit strategy to implement at that point in time? So in this podcast, we're going to focus in on rolling up in the same contract month. And what that entails is buying back the current short call. That's how all exit strategies start. And then we sell a new call option at a higher strike price in the same contract month with the same expiration date. So as an example, we buy to close the June 50 call and sell to open the June 55 call with the same expiration date. That's rolling up, and it's in the same contract month. Now let's turn to KMX and use this as a real-life example. And all of the examples I give in these podcasts are taken either from my own portfolios or from portfolios of our members that share trades with us. In this particular case, on April 25th, 2019, CarMax was purchased for $75.89, and on that same date, the 78 out-of-the-money call with a May 17th expiration, so 23 days out, was sold at $1.42. Well, since CarMax was trading at $75.89, we can kind of see visually, without even feeding it into the calculator, that the returns are going to be about 2% for the 23 days. But we'll show you that. We'll talk about that after entering it into the multiple tab of the Ellman Calculator. Now, what happened was on May 3rd, about 9 days later, CarMax was trading at $78.50. So it moved up from $75.89, almost $3 to $78.50. That left the cost to close the original 78 call at $1.70. So the question is, as it relates to rolling up, does it pay to buy back that 78 call and sell another call at a higher strike price, thereby allowing the shares to continue to appreciate? So if we took a look at the initial trade structuring of this trade using the multiple tab of the Ellman Calculator, our 23-day return would look as follows. With the stock trading at $75.89 and the 78 call sold for $1.42, the return on our option or RU is 1.9%. Again, 23-day return. So that's pretty good. Now, the upside potential, if CarMax moves from $75.89 up to the 78 strike, that will generate an additional 2.8% on the stock side. So when this trade was initially set up, there was a maximum potential of a 4.7% 23-day return. At the point in time where we're evaluating rolling up, that maximum has been met. It's not realized yet because we didn't sell the shares, but that's where it stands at that point in time, 4.7%. So should we mess with this trade at this point in time? Let's see. Here are some of the considerations. Now, if we rolled up to the 79 strike, okay, the cost to buy back the original short call was $1.70, as I stated in the last slide. It would generate $1.15 of additional time value credit when we sold the 79 call, so we would have a debit on the option side of 55 cents. 170 is our debit, 115 is our credit. We're at a debit of 55 cents. Now, if we rolled up to the 80 strike, then the 80 call would generate a lower premium because it's deeper out of the money, and that would be 75 cents. So our net debit on the option side is 95 cents. But when we roll up, we're increasing the unrealized value of our underlying stocks because we no longer have the original strike keeping the shares from appreciating. So there will be additional share appreciation by buying back the short call. So we're going to have to factor that into our calculations as well. And of course, taking no action is also a consideration. So let's break this down now. If we factor in unrealized share gain and upside potential from the new strike from the current market value up to the new strike, here's how it breaks down. For the 79 call, remember we had a net option debit of 55 cents. Well, the bought up value of our shares goes from 78 to 78.50. So that's plus 50 cents. And if it moves up to the 79 strike, that's another 50 cents. So the net gain in that particular situation, best case scenario, is for a credit of 45 cents. That's a 0.6% gain. Hardly worth going through this exercise. Now let's look at the 80 strike. Once again, we had a net debit of 95 cents on the option side, the same credit of 50 cents bringing our share value from 78 to 78.50, and now there's an upside of $1.50 from 78.50 up to the 80 strike. Best case scenario, a net credit of $1.05, which represents a 1.3% additional profit. Now that's looking a little bit better, but again, the price of the stock that had risen a lot is going to have to continue rising by another $1.50 to get to that 1.3%. So what we're doing here, if we're rolling up in the same contract month, is we're putting a successful trade at risk. Now, if we actually broke it down, how much it would cost us to close the original 78 call, we would then feed that into the Unwind Now tab of the elite version of the Ellman Calculator. And once we fed all this information, we would see that the cost to close was 1.54%. Now remember, our original structuring was 1.9%. Folks, I wouldn't take this trade with a 10-foot pole because we're taking on way too much risk for what is at this point in time a maximum 23-day return of 4.7%. So let's summarize now. Rolling up is just not a good choice. We ran through the numbers. Generally speaking, rolling up in the same contract month is something that I avoid. Of course, normally that's available to us when the stock price has moved up significantly and we're counting on it to continue to move up. You know, there's always the possibility of profit taking. Now, the mid-contract unwind exit strategy is definitely a possibility, but not in this case, because the cost to unwind, 1.54%, you know, if we go with the BCI methodology to do that, then we would have to feel secure that in the remainder of the contract month, we would have to generate an additional 1% over and above that, or 2.54%. That is unlikely and too risky. So, looks to us and to me, humbly stated, the best action to take is no action at all. Now, as we get closer and closer to expiration, 4 p.m. Eastern Time on expiration Friday, if the strike is still in the money as expiration approaches, then we can do our calculations for rolling out or rolling out and up. That's a different story. So, if we eliminate one exit strategy as a possibility, don't forget there might be another one coming up down the road. So we always have to be aware as to how and when to take action, and also when the best action is no action at all, as it was in the case of CarMax. So just as a reminder, which I always do in these podcasts, there are a ton of free resources on our website, www.thebluecollarinvestor.com. On the top black bar, you can get a free copy of the Ellman Calculator. There are put calculators and other files for free. Training videos. There's a beginner's corner tutorial for both covered call writing and selling cash secured puts, and so much more. You could get our free newsletter by logging into the blog page. Sign up, it's free, and it'll be delivered to your email box every Sunday morning at 10 a.m. Eastern Time. In the bluecollarinvestor.com store, we have books, DVD programs, ebooks, calculators, spreadsheets, trade planners, online mentoring programs, just a lot of educational products that will help elevate our returns to the highest possible levels. Ladies and gentlemen, thank you so much for taking the time to listen to BCI Podcast number 47, Rolling Up in the Same Contract Month. I hope you enjoyed this podcast, and I hope it puts cash in your pocket. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.